I've got a little topic in mind. It's much more actionable than some of the things we usually talk about. Given what's happening in the marketplace, I didn't think it'd be appropriate for us to be sitting here talking philosophy. So I figured we could go with a couple of symbols, and I'm very curious to get your opinion. And the topic is really what now? Okay, so I'm going to start with a few symbols, and I'm going to ask you, given what's happened over the last couple of days, how you think about these particular instruments. And I'm going to dance all over the topic and all over the globe. Gentlemen, are you ready?
Ready.
What now? 1 month ago, I'm going to talk volatility first. VIX is the instrument in focus. 1 month ago, the VIX was at 12 and a half. Given all the things that were happening in the world, that didn't really seem right. Monday, you get a VIX spike to 60. I'm going to put that in air quotes because I think we all know the wide markets in the VIX might have exaggerated the VIX relative to VIX futures, but we had a spike in the VIX on Monday. Knowing that volatility is mean reverting, that didn't really seem right either. We're now moving towards the upper 20s. And in my personal opinion, if the long-term range and the volatility index is somewhere around 18, it would make sense, given where we are in the cycle, for an elevated range of volatility. I think, Tom, you've been saying something like this, that we're going to see into the election elevated levels of volatility. It'd be good for trading, good for opportunity. We've seen a massive spike. We saw the easy short vol money made on Tuesday. I'm curious, what now? Tom, what are your thoughts now that the VIX is elevated at 26, but we're not at extremes on both the upper and lower price range?
Well, for starters, the VIX right here at 24 this morning, that's the futures, is perfect. I mean, the perfect range for me as a trader is 17.5 to 22.5. So I'd rather have 2 points above than 2 points below that range. Like I'd rather be at 24 than 15. When you say, what's next? I mean, I'm hoping it stays up here for at least, through the election. I don't think it will. I think the forward curve right now looks really good to me. Like it's exactly how I would have drew it, which means I think you're going to see actually a lower volatility from here through the election, and then it really start to flatten out as we get into, December and beyond.
Interesting. How did you, I didn't get to see if you did have this conversation already, nor have I talked to you about it. So I'm curious, what did you make of the VIX spike to 60? People are arguing over it tonight. It wasn't really 60, and it's
no, it wasn't. Yeah, it wasn't. Yeah.
And you get wide markets, and then you get some nickel bids on out of the money stuff, and it spikes. Do you think that conversation even matters? Did that even matter?
No. It's
60
just,
does it matter? How should a trader think about it?
No. It doesn't matter for anything other than it's just a little, fun topic to talk about. I mean, it shows some of the inefficiencies in pricing. The reality was none of that was tradable. In general, people have been arguing about the VIX now for 25 years.
Is that everybody understands it?
No. I'm just about the way they calculate the VIX. And it's always been, subject to, discussions about manipulation, calculation, all the above. In reality, it's worked out pretty damn good, all things considered. It's been pretty effective. When we think about it, you can go back 20, 25 years ago, 30 years ago. The idea that we can trade volatility and trade fear on its own is really fascinating to me. It helps to give us context in all the places we never had context before. Fear is a powerful emotion that, with respect to markets, that was something we really couldn't measure. We just had to get the deltas right to measure fear. Very difficult. It's way easier to reverse engineer by using VIX. So I think that in general, it's been pretty damn good.
Couldn't agree more. All right, let's take a trip across the pond. We've been talking, I think, in a lot of these conversations, obviously about U.S. technology stocks, in some ways Chinese stocks, never really Japanese stocks, even though they were trading at all-time highs. This move from Friday to Monday, Monday to Tuesday, had massive dislocations. And I think if you're in a high volatility regime, that's what you can expect. Massive overreactions on these moves, massive unwinding of positioning, which will create dislocations. And that's what we're ultimately trying to look for. It's, it would be great if we had this conversation on Monday, but we didn't. I want to bring it up anyway.
Okay.
So the Nikkei is absolutely swinging all over the place, which you would expect if their currency is trading like a meme stock. It has gone in just a few weeks, maybe inside of a week, from 71 down to a low of 61. In the last 2 days, it's recovered. I know it's not the most liquid instrument. I'm curious, what are your thoughts on trading Japanese markets given the crazy volatility in the Japanese currency, or Japanese instruments, I should say?
Basically untradeable. I mean, EWJ is tradable, so let's get that right. It's not great, but it's tradable. But the Japanese markets in general are very much probably the worst marketplace for traders in the whole world. You know, like if you're comparing it to, just as an example, like to China, you know, for China, we can trade individual, you know, there's individual stocks or things like that we can trade. But in Japan, I mean, it's just it's brutal. I don't think the options are not tradable. And you know, the stock we've traded it. I mean, we used to trade it pre-split. We had a fairly large position on there after the tsunami. You know, the way it's moved around in the last week, that's obviously not normal, and I wouldn't expect that to continue. So there was some crazy trade in there. When all you can trade is a country ETF, we all have like these nightmare memories of Russia from just a couple of years ago, trying to trade.
Locked up for a year.
Yeah, like as a trader, I don't really sit here and go, like I didn't trade EWJ at all earlier this week. I don't think Japan is really tradable. You know, I just don't think it is.
I guess you'd have to go to the currency if you're going to trade it.
Yeah, I mean, I trade the yen. And I like trading the yen.
That was going to be next. So let's go to the yen next, which Japanese futures have been, I mean, Japanese yen futures have been rocking. The thing that kind of sucked the other night is during the Bank of Japan announcement. Somebody said on Twitter, Tony, to me that you could drive your RV through the markets when they made that Japanese announcement. Like they didn't want to touch these things at all, which makes it hard for degenerates like me who are waiting for these Bank of Japan announcements to see where the opportunity is. The point is, you've had this massive run in strength in yen. You know, everybody has talked about that yen carry trade unwind. Blah, blah, blah. When you start to see every 19-year-old financial influencer in your Twitter feed making TikTok feeds making yen carry trade unwind videos, it's probably over. But I'm curious.
You know, probably.
I'm curious. You've seen a massive price extreme in one direction. If you look at this in a long enough time frame, weak yen, you've now seen on a shorter time frame a massive run in yen. Bank of Japan kind of said, I'm sorry.
I saw your tweet. It was very cute.
What now? Tom, is there still opportunity in the yen to the upside? Do you fade this move as you were fading bonds coming into this week? Japanese yen, Tom Sosnoff, what now?
I don't think there's very much downside risk in the yen at all. I think the yen is a perfect put selling of all the currencies. The yen is the best put selling vehicle right now. It's got decent vol. It has decent IV rank. You need to sell puts on down moves in there. You can't reach for it though. I've learned my lesson in the end. It's not a reachable product. You have to let it come to you. Meaning you've got to sell puts when it's ugly, and you can't when it's going up. You just got to let it go.
Got it. Is there a level that you like, or you'll know it when you see it?
Is there a level I like? Well, it really depends. I mean,
Full disclosure, he's long yen.
Yeah, full disclosure, I'm still long yen. I mean,
I am too a little bit, but I'm closing long yen versus.
You see, this is where I have
I'm short the 67.5 puts right now. That's my position.
Okay, this is where I have a disconnect with Tom. Just to play devil's advocate here for a moment.
Please.
Xiaojun came in and said, you know, he wanted to sell puts in Google. Google was up $3. It's only up $2 now, but that's neither here nor there. It was up $3 at the time. It was a skosh off of its lows. The yen, although it has had a huge move lower over the past 9 months, has made a monumental run to the upside the last couple of days. And you're looking to sell puts in there. It doesn't, you know, that almost seems like you have an opinion in the yen as opposed to the price movement.
I do.
Okay, so that's your
I do. I have an opinion.
Okay.
Yeah. I want to be long it. Okay. I want to lead.
That's when genius fails. Okay.
I'm allowed to have an opinion. I don't need you to tell me. I don't need permission. I want to.
I'm not asking you for permission, but for the audience, when a stock is $3 off of its lows and you won't sell puts, and the yen is how much does the yen move? 15, 20%? What would the yen move from?
What difference does it make? I'm bullish in the end. I don't need to give you a reason.
Of course, we don't need a reason for anything.
That's right.
But you have a directional bias in it would be your reason. So
that's right.
It doesn't seem logical to the audience. It doesn't seem logical to me.
Okay.
All right.
Thank you for that, but I don't care. I mean, I'm going to do what.
See what I got to work with, Victor?
I'm just telling you that, like, it doesn't. Fine.
Okay. All right. Let's do the next one. Bond yields are back above 4% today, coming in on Sunday and first call. The conversation, I think, Tom, your position was on any rallies, you take that opportunity to fade it. I jumped on that bandwagon. Bonds are now down 3 points, maybe more off their highs here. You got the reversion. Yields are above 4%. Tom, is the price extreme and bonds over? What now? You got your 3 point reversal. Bonds, what now?
Well, first of all, the price extreme in bonds is not over. Bonds are going to be in play until the Fed, obviously does whatever it is they do, because there's always going to be risk of maybe a surprise move, something like that. I will tell you that at 122, where the bonds are right now, the 75 or 100 basis points is off the table. I think you're talking right now 25 or 50, probably 50. If bonds drop under 120, it'll be 25. And if they drop under 118, all the bets could be off. I don't think I wouldn't get too hung up on interest rates going sharply lower. I think it's fair to say there's going to be, 1, 2, or 3 rate cuts coming up, but I wouldn't get too hung up on we're not going back to where we were, a couple of years ago at 0% rates. That's over. You're never going to see that again. Not in our lifetime, maybe in yours.
I hope not. Are you kidding me? Do you know what kind of destruction it would take to send us back to 0% again, to zero interest rate policy? Don't put that kind of juju on me and my generation, future generations, maybe in yours. So you take that back right now.
I mean, your generation loved low interest.
Your generation.
Oh, I think, hold on. First of all, let's be very honest, people. I said I wasn't going to go philosophical, but you've dragged me into the muck with you. Let's be very clear. Our world is governed by incentive more than it's governed by people. And when you drop interest rates and the cost of money down to zero and you distort every part of the financial incentive system that has governed our world, all of a sudden you wonder why you look outside and you can't recognize the world that you live in after 15 years of perverse incentives. Give me a break. I don't want to see zero interest rate policy ever again. And I think if people could connect behavior to incentives that are governing our world, they don't want to see it either. And they would have a better understanding of why the hell it looks so funny when they look outside their door.
So you're long the yen because you think after 10 years of the same policy, they're going to change today?
I'm long the yen because I think there's more normalization to be had. That's all.
Right. You think the past 10 years performance and the way they govern is going to change today to make the yen go higher?
Oh, no. Absolutely not. Absolutely. You want to respond to that, Tom? You're kind of chewing. You look like you're chewing on something.
No, I'm
Otherwise,
not.
I can go to the next one.
I bit my tongue this morning, so
I'm bad sushi.
And I mean, I didn't bite my tongue to be quiet. I actually bit my tongue. So no, I'm not chewing anything. I don't want to comment on it. I really don't.
Right,
I mean, I think we beat that to death. Go ahead. What's next?
So all right, last one. I'm going to make a little comment because I've got a couple of more minutes before I have to get out of here.
Oh, so we own the network, Vic. We got as much time as you want.
Oh, do you? That's great.
Yeah.
I'm here until the viewers don't want any more, which I'm probably overstaying my welcome here. I watched your podcast with Dylan, Truth or Skepticism, yesterday.
Okay.
I don't want to argue back and forth a bit too much, but I wanted to give you my quick thoughts about
Okay, I'd love to hear them.
my conclusion I came to. I came to the conclusion that your style dictates your point of view on the marketplace. Your style set, when you boil down options are all about rights and obligations. Your style is about taking obligations from the marketplace. So you sell an outlier move, you are obligated to provide liquidity to the marketplace. On an outlier downside move, you're obligated to provide buying liquidity. On an outlier upside move, you're obligated to provide short liquidity. And so when those outlier moves occur, Tom Sosnoff, because of his style, doesn't care about why it happened, because it doesn't matter to him. He has the obligation to provide liquidity at that point. Therefore, the news or the risk of why it's going to happen, it doesn't matter to you. And it also doesn't matter because in order for your style to work, you must be 100% consistent with your mechanics. Therefore, if there's some news article or some risk in the marketplace that is perhaps increasing vol or vol's low, your style has to stay mechanical. And therefore, you cannot care about news or risks in the marketplace because in order for your style to work, you've got to play blackjack, the same style, to give yourself the edge that you need to execute. So instead of arguing back and forth, which was like my knee-jerk reaction, I was like going to write you a scroll or email and tell you why you were wrong. I realized it's your style. And because you have your style, your point of view and philosophy, it all aligns. And somebody else has a different style because they don't want to take on that obligation well, then some of these things might matter to them, and preparing for certain risks might matter. But in your style, it doesn't matter. So there is no point in arguing with you because your philosophy aligns. You're taking the obligation. It doesn't matter how you get there because you got to deal with it regardless. What do you think?
Well, first of all, I'm not a market maker anymore, so
I'm saying you sell the range.
I
You're
understand.
obligated to take the outlier move.
I mean, so it's different. I'm not obligated to. I have, in return for not being obligated to, I have the option of being able to pick and choose when I want to participate. It's very different. So I have no edge, but I have the ability to pick and choose when I want to participate. That's the trade-off there. The rest of what you said is fairly accurate, but I don't see any issue with that. Like,
no, I don't either.
I also think that there's a distinction here. People that want to trade are different than people that want to try to predict what the market's going to do. The people that want to trade need to understand the mechanics. The people that want to talk about or predict what the market's going to do, we need those people to support the people that want to trade. Like, there is no trading amongst professionals alone. Like, you need everybody else to kind of set the table.
And let me give you the difference between those two people as well, if I might. So and I know I'm all the tasty traders are like, yeah, duh. But it's just more or less like putting these conversations in different terms. So and for the obligation, you're sort of accepting a potential drawdown scenario, larger than average drawdown scenario. And for that, you're going to get paid that premium between implied volatility over realized volatility, which is going to increase your daily returns. But in exchange for that, because the markets are always trade-offs, you're obligating yourself to drawdowns. And I think Monday, for all newer tasty traders, they saw what that potential other side can be and why it's so important to stay mechanical when you encounter those drawdowns, or when you encounter that scenario that's not just the simple I'm picking up the premium of implied over realized. You now have to deal with the other side of the strategy and why it's important to stay mechanical. Would you say that's fair as well? That was a lesson for new tasty traders?
Yeah, that's fair.
I was an olive branch today. No arguments.
No.
I would leave right there with the win, Vic. That's what I would do if I was you.
I'm out of here.
I think it's important though. Like, a lot of people wrote to me and they're like, I didn't get that. Didn't make any sense, that discussion. First of all, that was Dylan's idea, not mine, to cover that. He didn't even tell me before we had the discussion. He didn't say a word to me up until, right, like literally.
Look at Dylan.
So the reason was it was Dylan's fault?
Let's get out of this segment. I don't want any part of
me either. Let's get out of this segment.
No, hold on.
You returned my satin jacket from my photo shoot that I did when I was up on the wall.
I don't want to get out.
Very Tony-ish, isn't it?
So Dylan didn't tell me anything. We said wait until the podcast starts. And
Victor, your next discussion is going to be how Tom can't be wrong. That's going to be your next discussion.
Oh, yeah. So he's bothered. Dylan has always been on the other side of the business until Tasty. And so it's always been his job as a journalist to both entertain and explain, give reasons for why things happen. That's always been his responsibility and his role as a journalist.
Okay.
So the challenge for him is transitioning over to the trading side, where the counterparty mentality is, I don't care what you want to do. I just care that you do it.
Mm-hmm.
I only want you to create noise. I don't care what you do with that noise.
Yeah.
And so it's a very different animal. And what I'm trying to do to a group of, let's say, hundreds of thousands of retail investors is get them to understand that investing is not just about noise. It's about mechanics. The noise is your opportunity. The mechanics is your moneymaker, but you don't need a reason for the noise. You don't care.
I agree with some of what you're saying. I think there's a macro element that says these dynamics could create a higher probability of this potential outcome over a long term. I think some of that is helpful. I think figuring out why a move did happen doesn't always matter to the opportunist, because that doesn't actually help you to deal with the dislocation that's in the market now. But here's the flip side to that coin. And I wish, Dylan would have put this to you. You're a card player, right? You play poker. You lose a hand to somebody, a big hand, and they show you the cards. They throw the cards in the middle and you see they bluffed you. Okay? Now you're going over your mind. What bets did they make? How did they play this hand? And you just got information as to why something happened. And that reflexively is going to change how you play in the future. You just learned, is
Oh
the
my
player
God.
tight? Are they loose?
You are
How they-
giving some dumbass poker player way more credit than they deserve. They only show you that card so they can step on your neck. They're not showing that card. There's no thought behind, oh, I'm going to show him this card because now he's going to think about the way I thought
I
about the
don't know. It
progression.
depends on what level you're playing. Yeah.
No, I don't
would
care
say
what
it
level
depends
you're
on what
playing. They're all the exact same. They're every single poker playing monkey once you get over like a game with your friends is exactly the same level. And the only reason they show you that card, the only reason they do is to step on your neck. They don't show you that card because they're thinking, oh, now I can game him on my progression of my bets. None of those guys are that smart. They're all losers. They're all idiots. There's no chance. It is just a psychological step on their throat.
Tony, I thought for sure, because I thought about this last night. I thought for sure that would be like, if I say this to Tom, he'll meet me in the middle because he'll be like,
No.
you know what? I kind of
No, that bothers me.
I had no idea, like the concept that he could completely reject that argument outright. It didn't even occur.
Hold
to
on,
me
I'll
at
tell you
all.
why.
That's why he's the best.
Because I'm not even a good, technically, I'm not a good poker player because I can't
Technically, but you are.
stand the game because it's so boring and so slow. But when I'm
What
playing
is
poker,
technically- why is it so hard for you to say I'm not a good poker player? You have to throw in some weird qualifier.
nobody's-
What can't he do?
because nobody's a good poker player, it's just luck. But whatever, you got to pull. It's all luck.
I don't know. Faraz
remember-
us to the cleaners.
Oh please, hey
Tony, the first
but-
time I met Tom, I beat him. I was like a 21-year-old kid, and I go, "This guy looks like a sucker with a
Oh
lot of
my
money."
God.
And I had nothing. I had like a few pennies to my name. We're at a work party. I go, "Hey," I pulled out 3 cards. I had a deck of cards on me. That's
he
how
could do
know-
3
that's
card
how you know,
Monty.
like, what- I took him for like $60.
I'm
and
like,
3
where
card
did this
Monty.
kid? Where is this kid from? Like, is he on a street corner or something? But hold on, when I play poker, I'm going to finish this. When I go to play poker at the Bow, or whatever, at the casino with Steve and those guys and Jules,
Yeah.
like when I win a hand and I'm trying to, and it's a big hand, I'll turn over the card just to mess with them. Okay, for the same reason that they do it. So there's nothing to it. I don't think of it. It's just like, okay, here, you want to see it? I'll show you. Oh, I didn't have it.